Hello, I'm Kristen King, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. This week, we are asking, can you make money consistently following simple rules? Markets are becoming ever more complicated and connected, with new products, ideas, and paradigms emerging all the time. Fashions in investing change in just the same way that they do on the catwalk, and believe it or not, there was a time when no one had ever used the phrase risk on, risk off to describe the market. Against this constantly evolving background, can a simple, long-standing strategy make money over the long term? Or must investors constantly adapt and reinvent themselves to keep ahead? A lot of traders believe that you can make money by exploiting mispricing, repetitive trends, and patterns in the price action. But others believe that those opportunities will be arbitraged away as an efficient market closes the gaps and breaks the patterns. And yet there are anomalies which recur on a regular and sometimes near continuous basis. One such anomaly is the idea that the S&P 500 index makes most of its gains out of hours rather than during trading sessions. Research conducted by Bespoke Investment Group looked at the last 27 years of data, the period over which the SPY ETF that tracks the S&P 500 index has been trading. The firm backtested two simple but opposing strategies. One was to buy the S&P 500 index on the close and sell it on the following open. The other was to sell the index on the close and buy it back again at the next open, and the results were staggering. If you deployed the buy the close, sell the open strategy between 1993 and September 2020, you would have made 722%. However, if you had done the opposite and sold the close to buy the open, you would be down by 8.22% over the same period. The reason that the anomaly exists is that the futures in the S&P 500 trades around the clock while the index and its constituents do not. The futures markets are able to price in new information as it becomes available to them, and prices are adjusted accordingly, whereas the index proper has to wait until the stock market opens, and only at that point can the new information be factored in. Bespoke found that the success of the strategy reversed when COVID struck and news flow overnight became predominantly negative. But by late August, normal service had resumed, and being long overnight was once again the right way to be positioned. So, should investors follow this kind of recurring pattern, and what are the risks if they do? Well, of course, the window of opportunity can close or the pattern reverses, but being long of U.S. equities over the last 11 years has, by and large, been very lucrative. Overnight risk is not something everybody is comfortable with, but if you're not trading leveraged instruments like futures and options and just use vanilla ETFs to exploit these trends, are you at more risk than if you pursued a buy and hold strategy? Doing this opens us up to issues like trading costs, which may once have limited the effectiveness of this kind of short-term trading. But with the advent of commission-free dealing and fractional share ownership, these types of strategies could be executed for next to nothing and could potentially be automated as well. When looking at Trackstar IQ, our proprietary search tracking software, we see that hundreds of institutional investors regularly research ETFs, which shows that even professionals are happy to use these retail-friendly products. Of course, what we can't judge is how long the strategy will prove to be profitable for, as the profit and loss will vary on a daily basis. And just like a series of coin tosses, we have no way of knowing in advance whether or not we will get a long series of heads, i.e. profits, or tails, i.e. losses, in a row. Overall, then, a disciplined approach and patience, combined with sensible money management and trade sizing, are likely to be the keys to success in this type of systematic trading. That's all we have time for today, folks. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar. As always, make sure you do your own due diligence before making any investment decisions.